Were you asleep 6 hours ago? If you were, you may have slept through the moment the silver market split into two different worlds. Quick one, if you want clear real-time breakdowns like this as the setup unfolds, subscribe and turn on notifications so you're first to see the next alert when the signal shifts fast. You missed the moment silver didn't move, it cracked. Not a correction, not a rally, a break. While the West was sleeping, the East just printed $100 per ounce on physical silver. And in the financial media, your CNBCs, your Bloombergs, they're calling it a localized anomaly, the glitch. They're hoping you'll scroll past it and go back to checking your retirement account like nothing happened. But I'm telling you right now, the screens you're staring at in New York and London are lying to you. This isn't an unpriced move. This is a total regional decoupling that happened overnight while most Americans were asleep. History was made, the kind of history that doesn't get a headline until it's already too late to position for it. I'm not a YouTuber. I'm a private commodities analyst who has spent the last 12 years trading physical metals and monitoring bulk flows that most retail investors will never see. I built this channel using an AI avatar for one reason, to speak fast, because I got tired of waiting half a day for mainstream news to report what I was already seeing in real time, and frankly, I got tired of watching all these new AI-generated channels pump out fake hype, garbage speculation about silver, when there are real people out there, stackers, holders, retail investors like you, who need actual information, not clickbait. So here's the reality. The $100 print in Shanghai, that's just the smoke. The fire is what's happening to the Western vaults right now, and it's moving faster than anyone predicted. Physical metal is bleeding out of the COMEX and the LBMA at a rate that should terrify anyone holding paper contracts. And the arbitrage gap, the price difference between East and West, just hit $13.89. That's not a spread, that's a chasm. That's a market that has lost structural integrity. Let me be very clear about what I'm claiming here, because this isn't standard bull market talk. This isn't me telling you silver's going up because of some chart pattern or some Fed policy. What we are witnessing right now is a structural price reset, not a rally, a reset. There's a massive arbitrage gap forming between Eastern and Western exchanges. That gap is forcing a physical drain that the paper market simply cannot stop. They can write contracts all day long. They cannot print bars of silver. And here's the part that should make you sit up. Gold has been in a 77-day rising channel, pointing higher with disinflation. But as of 2 hours ago, silver has become the lead dog. It outperformed gold by nearly 4 times overnight. 4 times. When silver starts outperforming gold with that ratio, you're not in a normal market anymore. You're in the parabolic phase, the phase where things move so fast that by the time the talking heads on television figure out what's happening, the opportunity is already gone. So here's my promise to you. In this video, I'm going to walk you through the Shanghai price mechanism that just broke the back of the COMEX. I'm going to run conservative math on the gold to silver ratio, and I'm going to share exactly how I'm positioning my personal portfolio for a $130 reality, not speculation math, cold hard numbers that the mainstream media is too terrified to broadcast because it would expose just how fragile the entire Western pricing structure really is. This isn't about trading. This is about the survival of physical supply in the West. So before I show you my personal battle plan, you need to see the numbers that were locked in at 3 a.m. Eastern Time this morning, the numbers that confirm everything. Let's start with the hard data. The snapshot I pulled a few hours ago. Gold spot price, $4,624.39, testing the upper boundary of that 77-day rising channel I mentioned. Steady, disciplined, exactly where it should be. Silver spot price, $89.88, up 2.34% while the world slept. That's the New York price, that's the London price, that's the price you see when you check Kitco or any of the standard Western databases. But here's where it gets interesting. Shanghai silver, the price being paid for physical delivery in the East, is reported at $103.77. Let me say that again. In New York, you can buy silver for $90. In Shanghai, you cannot touch it for less than $103. This is the market that has been broken in half. The discount available in Western markets is $13.89. Think about what that means. If you secure physical silver in the West at $89 and ship it to Shanghai where it's trading at $103, you just created a $13 arbitrage profit per ounce. Minus shipping, minus insurance, minus the headache of international logistics, you're still clearing $8 to $10 per ounce on a pure arbitrage play. That is free money. And when free money appears in markets, smart money doesn't move eventually. It moves fast. It moves nonstop. Now I want you to look at the gold to silver ratio for a second. It's sitting at 51.4 right now. If you don't track this metric, here's the simple version. The ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, that number has swung between about 15 and 80 over the last 2 decades. When it's high, like 80 or 90, silver is cheap relative to gold. When it's low, like 40 or 30, silver is expensive relative to gold. Right now, we're at 51, which is middle territory. But the momentum is vertical. The ratio is collapsing, and it's collapsing fast. Here's the rider dynamic you need to understand. Gold moved up 0.6% overnight. Silver moved up 2.34%. That's a 4-to-1 outperformance ratio. When silver starts moving 4 times faster than gold, it has officially entered the parabolic phase of the precious metal cycle. This is the phase where retail investors wake up, check their phones, and realize they missed the entry point by 3 weeks. This is the phase where smart money is already positioned, and now it just watches the chaos unfold. And it's the part that keeps me up at night, because if the West doesn't close this 13 gap by the time the New York session settles today, something is going to snap in the physical silver pricing system. The COMEX runs a fractional reserve model. They hold a certain amount of physical silver in registered vaults. They issue contracts worth many times that amount. The system works as long as most people settle in cash. But when a $13 arbitrage opportunity appears, people stop settling in cash. They take delivery, they take the bars, and they ship them east. And when that happens, the whole structure starts to crack. Let's talk about arbitrage dislocation because this is the mechanism driving everything right now. If you don't understand this, you won't understand why the $100 Shanghai print matters. Arbitrage is the act of buying low in one market and selling high in another market. Same asset, different price. And in this case, it's not just a number on a screen. It's the actual movement of physical goods. Bars of silver being moved onto planes and ships and pushed across oceans. That's what we're seeing right now. Here's the analogy. Imagine 2 gas stations on opposite sides of the street. Station A sells gas for $3 per gallon. Station B sells gas for $4.50 per gallon. What happens? Everyone lines up at Station A. They fill up, they fill jerry cans, they fill every container they can find. They keep doing it until Station A runs dry. Then Station A has 2 choices: close the doors or raise the price to match Station B. There is no third option. The COMEX and the LBMA, the 2 biggest Western exchanges for precious metals, are Station A right now. They are selling silver for $89 while the East is paying $103. So the moment this market opens and the arbitrage desks wake up, they buy every available ounce in the West and push it east. This isn't theoretical. It's happening. I've seen the drawdown reports. Registered silver at the COMEX has been bleeding for weeks. It just accelerated. And here's why this is a trap for the exchanges. The COMEX can print all the paper contracts it wants. It can issue 1 million ounces worth of futures contracts in an afternoon. But it cannot print physical silver. It cannot conjure bars out of thin air. And when the arbitrage gap is $13, people stop trading paper. They demand metal. And that brings us to the most dangerous math in the world right now. Let's run the numbers. Conservative scenario first. If the gold to silver ratio simply stays where it is, around 51, and gold maintains this current channel around 4,724, then the fair silver value is roughly what we've been seeing in the West. That's the baseline. The nothing crazy happens scenario. But now let's stress test it. Let's run the math based on targets from panelists I actually respect, Rashad Hajiev and a few others, who have been calling for a gold to silver ratio of 40, not 51. 40. If the ratio moves to 40 and gold stays around 4,624, you divide that by 40 and you get 115/60ths per ounce for silver instantly. No additional move in gold required, just ratio compression alone gets you above 115. Now let's talk about the reset scenario. Silver simply resets to the Shanghai price of 103.77s. If the West just catches up to where the East already is, the gold to silver ratio drops toward the mid-40s. We're already leaning in that direction, and we're going to get there whether Western exchanges want it to happen or not. This is where the $13.89 premium matters. That premium is the pressure forcing the Western price ceiling to crack. Every hour the gap stays open, metal is pulled east. Every day, the COMEX refuses to let the price rise to meet Shanghai. It loses more registered inventory. They are bleeding out, and they know it. Here's what we know so far. Physical supply is being drained out of New York and London. The gold to silver ratio is collapsing. The numbers do not match. And yet you can turn on CNBC right now and they'll tell you everything's fine. They'll say it's a bull trap. They'll trot out an analyst to explain why $90 silver is unsustainable. So let's talk about the skeptics. Let's steal their argument, because if I'm wrong, I want to know why. The counter-argument goes like this. Shanghai silver is a localized liquidity spike, a temporary imbalance caused by Chinese New Year demand, or some regulatory quirk inside the Shanghai Gold Exchange. Skeptics claim $90 silver will kill industrial demand in solar panels and electronics, creating a supply glut that crashes the price back into the $70 range. That's the bearish case. Then there's the US dollar factor. The DXY, the dollar index, has been relatively stable, but if it rallies unexpectedly, it could break gold's rising channel and send silver tumbling back into the 70s. A strong dollar historically pressures commodities, and silver is no exception. Those are real concerns. I'm not going to pretend they aren't. But here's my rebuttal, based on 12 years of watching this market. Industrial demand is inelastic in the short term. Solar manufacturers cannot just stop using silver overnight. They have supply contracts, they have production schedules, they have panels in assembly that require silver paste. You cannot swap out silver for a different conductive material on a 2-week timeline. The industrial complex doesn't turn on a dime, and if a physical drain to the east is already happening, demand is not disappearing. Demand is being relocated. The silver that would have gone to Western industrial users is being diverted to Eastern buyers willing to pay $13 more per ounce. That's not a demand collapse. That's a pricing fracture. Now let's kill the idea that paper shorting can stop this. I've heard this line a dozen times. Bullion banks can just short the futures market and crush the rally. Yes, they can short the paper price. They can dump contracts and push the screen price down. But here's the problem. In a physical arbitrage situation, a paper short is just a promise to deliver metal that is currently being shipped to Shanghai. That's the naked position. It assumes you can find metal at expiration. But if the metal is already gone, if it's already on a ship halfway to China, you can't deliver. And that is where a short squeeze is born. Shorts can manipulate the paper price all they want. They cannot manipulate physical flow. And the physical flow is one directional right now. It's going west to east. So if skeptics are wrong, and I think they are, institutions only have one move left. They change the rules. So what happens next? Let me walk you through what I expect over the next few days and weeks based on historical patterns and what I'm seeing right now. First, institutional reaction. I expect massive margin hikes on the COMEX to shake out retail investors. This is a classic move. When exchanges feel threatened by a short squeeze or a delivery crisis, they raise margin requirements. Suddenly you need 50% more capital to hold the same position. Retail traders who are leveraged get margin calls. They panic, they close. The price drops. Institutions breathe again. Watch for that. If you see the COMEX announce a margin hike of 30, 40, 50% overnight, you'll know they're scared. You'll know delivery requests are piling up and they need to shake people out before it spirals. Second, media blackouts. I expect technical difficulties or data reevaluations around the Shanghai prints. Suddenly, the Shanghai Gold Exchange numbers will become unreliable or subject to review. Western financial media will stop reporting $103 and focus only on the New York spot price. They'll try to memory hole the arbitrage gap. Don't let them. Here are the specific indicators I'm watching. My dashboard. Indicator 1, the $91 breakout. If New York opens and pushes past $91, the catch-up is official. That's the signal Western markets are acknowledging the Shanghai premium and closing the gap. If we clear $91, we can go to $95 fast, then $100, then $110. Indicator 2, the gold to silver ratio at 48. We're at 51 now. If it crosses under 50 and presses toward 48, the decoupling becomes permanent, the point of no return. That's when even skeptics will have to admit something fundamental changed in structure. Now look at the 77-day rising channel on gold. It's clean, predictable. If gold breaks the top of that channel, if it pushes above $4,700, there's very little historical resistance until the reset levels. We're talking $4,900, $5,000. And if gold starts running free above that channel, silver goes parabolic. The ratio compresses toward 40 or lower, and $130 silver moves from wild to weeks. The trap is set. Institutions know it. Smart money knows it. The only question is whether retail investors see it before the window closes. That brings me to my personal battle plan. What am I doing with my own silver right now? What am I watching? What are my trigger points? I want to be clear. I'm not telling you what to do. I don't know your finances. I don't know your risk tolerance. I don't know if you hold physical bars in a safe trade futures or sit in a silver ETF. I can't give you advice, but I can tell you what I'm doing with my own money, and you can decide if any of it fits your situation. I'm monitoring 2 triggers. Trigger A. If silver clears $91 in the New York session today, I interpret that as the start of Shanghai catch-up. At that point, I look to increase exposure to physical-backed vehicles, not paper, not futures, physical-backed. That means allocated storage programs. That means ETFs that actually hold metal in vaults. That means if I can find it at a reasonable premium, buying actual bars and coins. I'm not touching paper contracts in this environment because I do not trust exchanges to honor delivery if this turns sideways. Trigger B. If the gold to silver ratio hits 40, like the analysts I follow expect, I treat it as a rebalance signal. Meaning, if silver outperforms gold until the ratio prints 40, I take some of that outperformance and rotate part of it back into gold. Why? Because at 40, silver can get overbought relative to gold. The ratio can snap back to 45 or 50. I don't want to ride every violent swing. I'd rather lock in some of the win and let gold do the heavy lifting for the next leg. Now here's my hands clause. If the COMEX hikes margins by more than 50% overnight, I sit on my hands. I'm not selling. I'm not panicking. I'm not letting paper volatility shake me out of physical. This matters. A margin hike is designed to create panic and force leveraged traders to liquidate. If you hold physical metal, a margin hike does not touch you. It only hits leveraged futures positions. So if you see the headline, COMEX raises silver margins by 60%, do not panic. That is weakness on their part, not strength. And here's the personal rule book I will not break. I am not selling physical metal as long as the Shanghai premium persists. Selling at $90 while it's trading $103 makes no sense. Why sell at a $13 discount to the global price? The only scenario where I sell physical is if the Shanghai premium disappears and prices converge. If New York and Shanghai are both at 103, fine. The arbitrage is gone, and I can make a rational profit decision. But as long as the gap stays open, I'm holding. And here's what's been bothering me for weeks, the thing I keep circling back to. The window is closing. The choice is becoming binary, physical metal or paper promises. And in an arbitrage dislocation, those are not the same product. Paper can be printed. Paper can be rehypothecated. Paper can be cash settled if an exchange decides it doesn't want to deliver. Physical cannot. Physical is physical. No margin hike, no regulatory tweak, no exchange rule can make it vanish. So here's what I'm asking you to do. Don't take my word for this. Go look at the data yourself. Pull up COMEX registered silver inventory charts. Look at the drawdown over the last 6 months. Pull up Shanghai Gold Exchange daily reports. Look at the premiums they've been paying for physical. Pull up the gold to silver ratio chart and look at the momentum. It's all there. It's public. You don't need a Bloomberg terminal to see this. You just need to know where to look. If you do the work, if you pull the data and you see what I'm seeing, then you have a decision to make. Are you going to position for this, or are you going to wait for CNBC to tell you it's safe? Because by the time CNBC tells you it's safe, silver will be at $120. The gap will close. The opportunity will be gone. That's how this works. Mainstream financial media is not your friend in moments like this. They exist to keep you calm, keep you in your index funds, keep you from making sudden moves that could destabilize a system. I'm not saying they're evil. I'm saying the incentives are not aligned with yours. My incentive is simple. I want to make money in this market, and I want other retail stackers and holders to understand what's actually happening. That's it. I don't work for a bank. I don't run a fund. I don't have institutional clients who need me to stay on message. I'm just a guy who's watched silver for 12 years, saw this dislocation building weeks ago, and built this channel so I could share it in real time instead of waiting for the press to catch up. I know some of you are skeptical of the AI avatar. I get it. It feels strange. But here's the reality. I can write and record a script like this quickly, publish it, and get it in front of you before the New York market opens. If I did this with traditional production, camera, lighting, editing, rendering, it takes hours. By the time it's live, the data is stale and the arbitrage gap has moved. The AI avatar is just the delivery mechanism. The analysis is mine. The data is mine. The opinions are mine. So if you're still here, if you made it this far, you're the target audience. You're the retail investor who wants real information and is willing to do the work. You understand markets are not a level playing field. You need every edge you can get. You're the stacker who's held physical silver for years, wondering when price would finally reflect supply and demand. You're the trader watching gold's 77-day channel and thinking, something bigger is unfolding. You're my people, and I built this channel for you. Here's what I need you to do right now. Watch the New York Open today. Watch whether we break $91. If we do, come back to this video and leave a comment. Tell me what you're seeing in your local market. Tell me if premiums are spiking at your coin dealer. Tell me if allocated storage programs are sold out. I want to know what's happening on the ground because the screen data is only half the story. The other half is the real world. Coin shops, vault programs, private sales. That's the data institutions can't manipulate. And if we don't break $91 today, that's fine too. It means the pressure keeps building. It means the COMEX is digging in, which means it either lets the price rise and continues bleeding registered inventory, or it prays the Shanghai premium disappears on its own. Maybe it will. Maybe Chinese buyers get spooked. The premium evaporates and the thesis falls apart. I'm not pretending that's impossible. I just don't think it's likely. I think the physical demand is real. I think the arbitrage is real. And I think the institutions are trapped. Now let's talk about the gold piece, because I titled this Watch Gold Closely for a reason. Gold is the anchor. Gold is the steady hand. Gold is the $4,600 foundation that makes the silver thesis possible. If gold breaks down, if it falls out of that 77-day rising channel, the whole thing unravels. Silver will not hold $90 if gold is at $4,200. The ratio doesn't work. The momentum dies. The trade is over. So you watch gold every day. I'm watching the channel boundaries. Upper boundary, around $4,680 right now. Lower boundary, around $4,540. As long as gold stays inside that channel, the thesis holds. If it breaks above, we go parabolic and silver follows. If it breaks below, we abort and wait for the next setup. And here's the part most people miss. Gold doesn't move on fundamentals the way stocks do. Gold moves on fear. Gold moves on central bank policy. Gold moves on geopolitical instability. Right now, you have a perfect storm of all three. You have fear about U.S. debt sustainability. You have central banks buying gold at record levels. You have geopolitical tension in the Middle East, Eastern Europe, and the South China Sea. That is fuel. As long as that fuel is there, the 77-day channel holds. But if something changes, if there's a peace deal, if the Fed pivots unexpectedly, if the debt ceiling gets resolved in a way that calms markets, gold can break down. And if gold breaks down, silver gets wrecked. That's the risk. That's what I watch more closely than anything else. Not the silver chart, the gold chart. Because gold is the foundation. Here's my take. If you bought physical silver as a long-term store of value, nothing has changed. The thesis is intact. In fact, it's more intact now than a year ago. So if you're a long-term holder, you hold. You don't sell at $90 just because price woke up. You sell when the thesis breaks, and the thesis doesn't break until central banks stop printing and governments balance budgets. Good luck waiting for that. If you bought silver as a trade, if you're up 50% or 100% and you're thinking about taking profits, you must decide whether you believe this is a reset or a normal bull run. If you think $90 is the top, take profits and move on. But if you think this is a structural reset, if you think we're going to 130, then selling at $90 is selling before the main event. Now, to the people not in silver yet, the ones thinking, I missed it, it's already $90. You're not too late. You're early to phase 2. Phase 1 was the grind from $70 to $90, the accumulation phase, when smart money built positions while the media declared precious metals dead. Phase 2, the phase we're entering now, is the recognition phase. This is when the market wakes up to the Shanghai premium, when arbitrage becomes too obvious to ignore, and when Western prices catch up to Eastern prices. This phase is faster, more volatile, more profitable than phase 1, but it's also riskier. If you're thinking about entering now, here's what you need to know. Don't chase. Wait for a pullback. We could easily get a 5 to 7% correction on profit taking or a margin hike scare. If silver drops to $84 or $85, that's a cleaner entry. If it never pulls back, if it rips through $91 and keeps going, then you missed this window. Don't FOMO in at 95. Wait for the next setup. There is always another setup. But whatever you do, don't buy paper contracts in this environment unless you fully understand delivery risk. The whole point of the arbitrage thesis is that physical metal is moving. Paper is a promise. Promises get broken when pressure gets high enough. If you want exposure, consider physical-backed ETFs, allocated storage programs, or actual bars and coins. Yes, you'll pay a premium. Yes, it's less efficient than futures, but you'll sleep better knowing you own something real. Now let's address the elephant in the room, the thing nobody wants to say out loud. What if the exchanges just cheat? What if the COMEX and the LBMA see the arbitrage pressure, see registered inventory draining, and they change the rules? What if they suspend delivery? What if they force cash settlement? What if they do what they did in 1981 when the Hunt brothers had them cornered? It's a legitimate concern, and the honest answer is they probably will try. History says they will. When exchanges feel existential pressure, they change rules. They've done it before. They'll do it again. But here's the real question. Will changing rules stop physical flow. Rule changes work when pressure is speculative, when hedge funds pile into futures with no intention of delivery. Then margin hikes crush the rally and everyone leaves. But this isn't purely speculative. This is arbitrage. This is physical metal moving west to east because there's a $13 profit attached to it. You can change COMEX rules all you want. You cannot change the fact that someone in Shanghai is paying 103 while someone in New York is selling 89. That gap persists until one of two things happens. Either the Western price rises or Western supply dries. So if I'm right, the $130 scenario isn't the end. It's the middle. After $130, we could see 150, 175, maybe even $200 if things get disorderly. But you need to understand something about parabolic moves. They end. And when they end badly. The 1980 silver squeeze ended with a massive crash. The 2011 run ended with a massive crash. This one will end too. And when it ends, it will be fast and brutal. So if you're holding silver into a run to $130 or $150 or wherever it tops, you need an exit plan. You need to know what price you're taking profits. You need to know what percentage you're willing to ride down. Because if you don't have a plan, you will freeze. You'll watch it run to $175, convince yourself it's going to $300, then watch it crash back toward $90 in weeks, and you'll end up right where you started, except emotionally wrecked. Don't let that be you. Have a plan. Take profits on the way up. Don't try to nail the exact top. Sell a third at 110, sell another third at 130, let the last third run, or whatever fits your situation. Just have a plan. And here's my final word. The data is the data. The Shanghai Premium is real. The arbitrage is real. The physical drain is real. The gold to silver ratio is collapsing in real time. Those are facts. What isn't fact is where this goes next. I can map scenarios. I can show historical patterns. I can tell you what seems likely. But nobody can guarantee outcomes. Markets are chaotic systems. Anything can happen. So take in information, do your research, make your decisions, and whatever you decide, do it with conviction. Don't half-step in a market moving this fast. Either you believe the thesis and you position, or you don't and you stay on the sidelines. There's no comfortable middle ground when the tape is moving like this. Watch the $91 level. Watch the gold to silver ratio. Watch COMEX registered inventory. And most importantly, watch gold's 77-day rising channel. Because if gold breaks, everything breaks. But if gold holds, we're going to $130. That's not a prediction. That's a map. The screen is lying. The vaults don't lie. And the vaults are emptying, that's it. That's the video. I'll see you in the next one. Let me know in the comments below. If Shanghai is already pricing silver like this, what do you think happens to the paper price when the West finally has to catch up?